Hello and welcome to the Monday Futures Market Outlook for November 7th, 2011. This is Patrick Serezna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, a 5-day complimentary membership is available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. When we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that we've gone through. We bearishly crossed below that about 4 or 5 months ago, and now are bullishly again trading above that 80-week moving average. So long as the market in general holds up at these higher levels, we are not in bear market territory, and there's room for the market to advance. Just to make some key intermarket observations, we have seen bottoms now for the year in the stock market and in many commodities. And even after that very strong October month, we're now seeing a much needed consolidation. This consolidation obviously could take even 2 weeks to play out, but so long as the key support levels are held, then the market is in a position to continue to advance. The environment is dynamically shifted as what we continue to see poor geopolitical and economic news coming out, but the market is no longer fearful of that news. We're seeing a market that brushes off bad news. That's a very natural thing to see in markets that are poised to move higher. Usually that means that all of the sellers that were intending to sell have already gone through the sell cycles, and the market is now in a position to advance. Now obviously depending on the news, the market may consolidate further this week, but so long as the bulls hold support lines, we'll talk about where those support lines are in a moment, then more than likely any of these pullbacks will likely be buying opportunities for the remainder of this year. When we take a closer look at that S&P 500 chart on the daily charts, we've obviously had a huge 200 point plus rally from top to bottom in the month of October, creating a historical 1 month run. At this stage, after such a huge advance, it's very natural for the markets to go through a consolidation phase where they absorb that. So really at this stage, even this week, if we reject off this 1260 area, we could see markets that even consolidate even as low as 1180 on the downside to kind of just wash out all the people that are looking just to lock in profits and to kind of create the next really good buying opportunity. But so long as all of the selling is pretty much contained above this 1180, 1200 area, and preferably even above the 1210 to 1220 area, we will certainly see a flagging or wedging formation develop that will more than likely propel this market up to the highs of the year by the end of December. So we'll be watching to see how this whole consolidation develops. But again, we may see short-term weakness, but that will probably emerge as a buying opportunity. In general, I would become substantially more negative or bearish if we saw price action deteriorate below 1200 and 1180 and simply not have the capacity to rebound. Once we get under 1180 on the downside, then a whole number of more bearish scenarios would have to come to light. But let's give the bulls the benefit of the doubt here. Next year, when we take a look at the U.S. dollar index, we've seen a substantial rally in the U.S. dollar in the month of September and a substantial sell-off in the month of October, giving almost everything back. The U.S. dollar now is far more neutral and range-bound than it was trending. We really wanted to see if the U.S. dollar was in a nice clean trend, we would have wanted to see support lines hold at much higher levels. Now, while there's room for the U.S. dollar to advance, as we see a lot of different global currencies still feel a little bit toppy and have overhead resistance, so there's definitely room for the U.S. dollar to even temporarily strengthen back to 79.80 on the upside. But at this stage, I would be far more neutral on the U.S. dollar being range bound than looking for a new robust uptrend. Next year, when we take a look at copper futures, copper is now put in a double bottom along the downside, and even these little pullbacks we've seen in the last few days have been holding that 340, 350 focal point support line. Really, at this juncture, these support lines, if they do hold, copper can advance all the way up to 380, 390 on the next push on the upside. It would take substantial weakness below 340 for us to really start being a little more skeptical about copper. But if we did see a scenario where the US dollar was very strong, copper could theoretically work its way all the way back to that $3 support line on the downside. Next year, when we take a look at gold futures, gold was for a while creating these bearish wedges that looked like they were going to break down. But in that the middle of October, there was a substantial reversal in gold that really now has pushed it solidly above the 1700 level. And I think in general, above 1700, gold is very neutral, and that would mean that I would treat it again more range bound. Above 1700, gold can work its way all the way back up to 1900 in a methodical rally, but anything below 1700 would immediately have warning bells going off that gold can still have consolidations not only to 1600 but 1500. So it remained relatively long gold above 1700 and cautiously short gold below 1700. Next year, when we take a look at crude oil has also done a really good job holding in the rallies. In fact, the rally in crude oil was impressive, but what has actually impressed me is the fact that the oil bulls would not let the $90 level be taken out. At this stage, we continue to see consolidations being contained and overall oil holding these lines. That in itself could propel oil all the way back to $100 a barrel on the upside as soon as we have a breakout to a higher high. So really at this stage, we're cautiously optimistic about crude oil on the upside. Even if we had a temporary dip, let's say down to $87 or $85 on the downside that immediately reversed back above 90, that would be a fine by us on a technical basis. It would be only sustained price action below $85 that we would start to be concerned about this current technical uptrend. Next year, I want to take a look at those 30-year Treasury bonds, and this is a very important chart to look at for forecasting the stock market. In general, these Treasury bonds have been moving inversely to the stock market, and so really at this stage, we had these beautiful breakout candles on the upside in the first week of November that have tried to break above this 140, 142 support resistance line. Really at this stage, if for whatever reason Treasury bonds took off to new highs, or retesting those new highs, that would really signal the market that the really big money is concerned again about the circumstances going on in the geopolitical fronts. And that would certainly cause the stock market to deteriorate. What we're really looking for in order to remain relatively bullish the stock market, we're looking for treasuries to continue to struggle at these existing levels between the 141, 142, 143 levels. If we see the treasury bonds reverse off this level and begin a drop back down towards that 134, 135 line, that would certainly motivate the stock market to make its next advance push higher. In the same regard, we can start being very skeptical about the sustainability of any stock market rally if treasury bonds really break out here and start pushing to new highs. That would force many of these treasury bonds to start yielding again at less than 3% range, which would be very bearish for the stock market. That was your Monday Futures Market Outlook. Thank you for joining me.